Hi friends, welcome to the channel JV and CIV Made Simple. So today we are diving into a crucial topic for anyone involved in international trade, and the topic name is Documentary Letter of Credit. That is our Unit 4 of BFM. We will also be talking about the guidelines that make these transactions secure and reliable. So these are the topic which we are going to discuss in this particular unit. The first thing we will discuss is objective, then introduction, definition of LC, types of letter of credit, operation of letter of credit, UCPDC, and there are different parties involved in LC and what are their liabilities, responsibilities, and right. And what are the documents under LC? How to scrutinize? What is crystallization? And follow up for bill under LC and safeguard for bank. And then we will discuss what are the risks relating to the letter of credit transaction. What is a standby letter of credit? In short, it is called SLBC. And then we will discuss uniform rules for bank to bank reimbursement, that is called URR 725. And then after we will see ISBP 745 and Incoterms, which is very important. And finally we will end this chapter with case study. So in this particular lecture we will touch first 3 to 4 topic, okay, and this complete entire lecture we will cover in 3 to 4 parts. Each parts will cover each and 3 to 4 topics from this particular slide you can see. So let's begin with the first topic that we have. This is regarding introduction to letter of credit and UCPDC. So what exactly is letter of credit? Think of it like a safety net that connect buyer and seller across different countries, right? So imagine you are a seller. So you are a seller and you are shipping goods half away around the world to a buyer you have never met. So you are shipping goods, you are seller and you are shipping goods to a buyer around the world half away you have never met. Naturally you would want some assurance that you would get payment, right? That is what where letter of credit comes into picture. So a letter of credit is a promise. You see the definition. It is just like a promise often issued by a bank. This promise is given by a bank that guarantees the buyer's payment to the seller provided certain conditions are met, like the goods being shipped as agreed. So it is, you can treat it like a trust certificate. You can treat this letter of credit like a trust certificate that say if you do your part we will make sure you get paid. This is vital in international trade where buyer and seller could be thousands of miles apart and may have never interacted before, right? So that is what it has been said. It has been told that if you do your part we will make sure you will get paid. That's the key point. But the question is, how do we ensure that everyone is on same page with this letter of credit? That's where International Chamber of Commerce comes into picture, right? That is called ICC. They are based in Paris and they have been around since 1919 working to make global trade smoother and safer. What is the full form of UCPDC? They have created that uniform customs and practices for documentary credit. So ICC has created this UCPDC and they have been around since 1919 working to make global trade smoother and safer. So to standardize how this letter of credit work, the ICC created a set of rules called UCPDC, that is called Uniform Customs and Practices for Documentary Credit. These rules help make sure everyone involved, that is who are involved, buyer, seller and bank. Okay, so these UCPDC rule ensure that everyone involved, that is buyer, seller and banks, follow the same guideline. The UCPDC was first introduced way back in 1933 and it is being updated several times to keep up with the changes in the world of trade and banking. The latest version called UCP 600, you can see the latest version name UCP 600 was released in 2007. When it was released in 2007. These updates are crucial because they adapt to the evolving nature of international business, making sure transaction remains secure and trustworthy. So if you summarize this particular slide, letter of credit are essential tool that provide a safety net for international trade. They help ensure that seller get paid and buyer get their goods even if they are miles apart. And thanks to the UCPDC guidelines set by the ICC, everyone know the rules of game. So in the next slide, we will dive deeper into how a letter of credit actually work and the different types you might come across. So hopefully you have understood the basics of the letter of credit. Now let's talk about the concept of a letter of credit and origin of this guideline. Did you know that the root of the UCP actually date back over a century? So the very first idea for this standardized rule emerged in a meeting in 1920 known as the New York Banker Commercial Credit Conference. It was at this conference that the groundwork for what would become the UCP was laid out, recognizing the need for clear, uniform standards in international trade. The version of the UCP we use today is called UCP 600. It came into effect from 1st July 2007. It is the latest revision and it provides clear guidelines on how transactions under letter of credit should be handled. These rules are essential for ensuring a uniform interpretation and consistent application across global trade. No matter which country you are in, everyone follow the same playbook. Now let's talk a bit more about some of the earlier version of UCP and what they brought to the table. One of the first version called UCP 82, right, which was introduced in 1933, right. So here are few of its key point. First, banks were made responsible for examining all the documents related to a transaction. That's what it has been said. Banks were made responsible for examining all the documents, right, related to a transaction. Bank has to ensure that these documents appear in order. So these documents appear in order. This bank has to ensure. And so what does it mean? Documents in order. What does it mean? Which means that they are correct. The documents are correct and meet the agreed upon standard. The documents are correct and they meet the agreed upon standards. So the first thing, bank were made responsible for examining all documents. The second thing is that they had to ensure that these documents appear in order, which means they were correct and made the agreed upon standard. Now the second term called honor, right. The term honor was also introduced in this version, referring to the bank commitment to pay or accept draft as long as the terms of letter of credit were met, right. This term honor was also introduced in this version, that is UCP 82, and it refers to the bank commitment to pay or accept draft as long as the 82 the term honor was introduced. You can see the term written here. This term honor was introduced in this version. It refers to the bank commitment to pay or accept draft as long as the terms of letter of credit were met. So what does honor means? It means bank's commitment to pay. Simple word I can say, bank commitment to pay or accept draft. Two things can happen, either it can pay or it can accept draft. That is called honor, right. As long as the terms of letter of credit were met. This version specified requirement for both thing. First is transport document and second is insurance document. That is about UCP 82. Now finally UCP 82 established that bank could accept other required document as presented without taking on any further responsibility. So this was the final thing about UCP 82. UCP 82 finally established that the bank could accept other required document as presented without taking on any further responsibility. Essentially, if the document appeared to meet the criteria, bank could process them without questioning their authenticity beyond the face value. That is the point it has been said here, that UCP 82 established that the bank could accept other required document as presented without taking on any further responsibility. So if the document appeared to have met the criteria, a bank could process them without questioning their authenticity beyond their face value, right. So this is all about UCP 82, and these early provision laid the foundation for the robust and secure system of trade we see today under the UCP 600. right? So hopefully you have understood the basic thing regarding UCP 82, what they are responsible, what is the meaning of word honor, and honor for what, which type of document, transport and insurance document. Okay, now let's come to the next slide, that is we discuss some more specific rule from the early UCP version and see how these guidelines have evolved. One important feature of UCP guideline is how they handle expiration date. So here you can see expiry date, that is called expiration date. So imagine a scenario where documentary credit expire on a holiday. So suppose this documentary credit expires on a holiday. Okay, so according to the what happened then, if the documentary credit expires on a holiday, what will happen then? According to the UCP rule, the expiry date is automatically extended to the next business day. You see here, it is extended to the next business day according to the UCP rule. This ensures that no one misses out on the fulfilling their obligation simply because the bank was closed, right? So that's the key point here. The early guideline also defined specific terms like effectiveness of documents and clarified what certain timing phrase means, like for example the phrase first half, okay, or middle of the month, were given clearly definition to avoid any confusion. This level of detail help everyone ensure that everyone was on same page literally and figuratively. Now let's move on to the UCP 151 that is introduced in 1951. This version brought some key changes and shaped the way letter of credit operate even today. One major change was the revision of terminology. That is the key point. That is the revised terminology. This was one of the major changes. Revised terminology. So applicant was used to replace principal. This might seem like a small change, but using clearer, more standardized language makes the process easier for everyone involved. Now, UCP 151 also introduced different settlement method. What are the settlement method? This method include payment, acceptance, negotiation and purchase. These options give flexibility in how transactions are handled depending on the need of the buyer and the seller. Depending on needs of buyer and seller, these methods include payment, acceptance, negotiation, and purchase. These options give flexibility in how transactions are handled. A crucial point that was highlighted in UCP 151 is the parties involved in documentary credit operation deals with document and not goods. In other words, bank and other entity don't verify the goods themselves. They only verify the document related to the good. This is very important part, which is even taken care of today also, right? So this emphasizes the importance of having all the documents in the proper order. Banks are required to determine the compliance based solely on the document presented. So they don't physically inspect the good. Their bank job is to make sure that the paperwork check out, right? So that's the key point. Bank must determine compliance based solely on the document. Bank don't physically inspect the good. Their job is to make sure that the paperwork checks out. Another key provision that was introduced in UCP 151 was about the time bank have to examine these document, right? That is about the reasonable time. The rule specifies that the issuing bank are allowed a reasonable time to review document, ensuring everything is in order. This will help prevent the delays. This will help prevent the delays and misunderstanding. Moreover, it was stressed that the description on the commercial invoice, the description on the commercial invoice must exactly match the description in the letter of credit. This is a key point, that commercial invoice description, it must match the letter of credit description. Consistency here is crucial to avoid any dispute. So as you can see, these guidelines ensure that international trade remain structured and secure. With each version, UCP has adapted to make sure the process is as clear and reliable as possible. So that was about UCP 151, revised terminology, settlement methods, and bank must solely rely on documents, and something related to reasonable time. All these things were introduced. Now Let's talk about so far we have discussed the early version of UCP. Now let's move forward in time and see how the rule evolved in 1960, 1974, 1970s and 1980s. So we will start with UCP triple two, right? UCP triple two. Let's start with UCP triple two, which came out in 1962. This version was notable because it marked the adoption of UCP guideline by bank in the UK and the Commonwealth. So UCP is UCPDC adopted by UK and Commonwealth Bank. This means that these rules become binding on all parties involved in international trade. It will become binding on all parties involved in international trade within this region, making UCP guideline a global standard. One of the key provisions that was introduced in UCP triple two was the rule that the letter of credit is entirely separate from the underlying sale. Try to understand. Credit is separate from the underlying contract, underlying sales or other contract. So, what was the rule? This means that even if there is a dispute, even if there is a dispute between buyer and seller, even if there is a dispute between buyer and seller, the letter of credit remain unaffected. Even if there is a dispute between buyer and seller, the letter of credit remain unaffected, and bank must still honor their commitment based solely on the document presented. Right. So this was one of the key provision introduced in UCP 222, that letter of credit is entirely separate from the underlying sale or underlying contract. Even if there is a dispute between the buyer or seller, the letter of credit will remain affected, and the bank must still honor their commitment based solely on the document presented. The next thing is introduced by UCP triple two was guidelines that allow confirming bank that provide guarantee on the top of issuing bank commitment. So what does confirming bank do? They provide guarantee, right? They confirm that they provide guarantee, right? So UCP triple two also introduced guidelines that allow confirming bank to negotiate without recourse. This means that once the confirming bank has paid the beneficiary, it cannot claim the money back, providing more security to the seller. Try to understand. One thing is called beneficiary. Who is beneficiary? Beneficiary is the seller. Why he is beneficiary? Because he will receive the amount since he has sent the goods. And this confirming bank has confirmed. That means it has made payment to the seller, right? And the term here is without recourse. Without recourse means once the confirming bank has paid the beneficiary, it cannot claim the money back. So this will provide more security to the seller. So remember this word without recourse. This will play a crucial role in this topic also, and in the next chapter also, unit number 5. There were also guidelines for handling situation where the first beneficiary, often in transferable letter of credit, fails to substitute his own document. So the key word is first beneficiary fails to substitute its own document, right? This provision helps clarify how banks should proceed in such case, reducing delays and confusion. Next we have UCP 290 that was introduced in 1974, and this version brought in some new terminology and rules that are still relevant today. One significant addition was the introduction of the term nomination. This term refers to the authorization given by the issuing bank to another bank. What is the meaning of this term nomination? Authorization given by the issuing bank. Authorization given by the issuing bank to another bank. So who are the another bank? Another bank is none but a confirming or advising bank. So authorization given by the issuing bank to confirming or advising bank to do what? To either pay, to either accept, to either negotiate, or to fulfill other duties under the credit. That is what is called nomination. Nomination refers to the authorization given by the issuing bank to another bank, usually confirming or advising bank, to pay, accept, negotiate, or fulfill other duties under. He also included rules for handling the inconsistencies between documents. So here you can see added rules for handling inconsistencies between documents. It is a common for minor difference to arise. And what are the minor difference? Slight discrepancies in dates, right? Slight discrepancies in dates, slight discrepancies in description, Right. So these are some of the minor differences which can arise. These will provide clarity on how to handle such inconsistency, ensuring a smooth processing of letter of credit. So we are talking about UCP 290, which was introduced in 1974. Now this version also includes provision for combined transport, which refers to the goods being transported by more than one mode like seas and rail. The next is assignment of proceed. So and a 21-day default period for presenting document after issuing the transport document. These additions were designed to keep up with the changing logistic and need of the global trade. Finally, let's look at UCP 400, which was introduced in 1983. This version further refined and clarified the rule to align with the realities of the modern banking and international trade practices. So, UCP 400 continued to strengthen the framework for documentary credit, ensuring that the guidelines provided bank with clear instruction on handling various scenarios. While specifics are not covered in this particular video, it is important to note that each update brought improvement that made international trade more reliable and efficient. So as you can see, each version of the UCP has built upon the last, refining the rule to better support the need of the global trade. In the next slide, we will explore the current UCP 600 guidelines. And no, before that, let us jump to the UCP 400. UCP 400, which came out in 1983. It makes a significant turning point for the UCP guideline. One of the major change in this version was the restructuring of the UCP. You see this word, restructuring of the UCP text into modern layout that we are familiar with today. This made the guideline more user friendly, easier to navigate, and more accessible for bank and trader worldwide. Another key provision in the UCP 6400 advise bank to check the authenticity of the letter of credit with reasonable care. This means that bank were expected to take practical steps, right? Bank were expected to take practical steps. It advised bank to check the authenticity of letter of credit with reasonable care. Bank were expected to take the practical step to verify that the letter of credit they received were genuine, which added another layer of security to the international transaction. That was called authenticity of the credit with reasonable care. Then the next part is bank employee verifying the document authenticity. UCP 400 also introduced a new settlement method which was known as the deferred payment undertaking (DPU). So this method allows bank to promise to pay the beneficiary at a later date rather than immediately upon presenting the document. So a bank did not pay immediately. As suppose a beneficiary comes to the bank with documents, so bank make the payment at some later date. So it provided more flexibility in how payment could be structured, which was a valuable addition for trader needing time to manage their cash flow. And then the next part is deferred payment calendar and clock icon, right? So this version also added a separate article on original document and bank to bank reimbursement. So these addition clarified the role and responsibility of bank when handling original document and processing reimbursement between bank. Two things here: original document and processing reimbursement between the bank. By clearly defining these processes, UCP 400 helped reduce misunderstanding and disputes. Finally, UCP 400 provided a definition of the transshipment. What is the meaning of transshipment? Transshipment means transfer of goods. Transfer of goods from one vessel to another vessel during the transit, right? Transfer of goods from one vessel to another during the transit. Having a clear definition helps set expectation and reduce potential dispute over the handling of goods that need to be transferred between modes of transfer. So with this improvement, UCP 400 laid the groundwork for modern UCP guideline, ensuring that the letter of credit remained a reliable and secure method of payment in the international trade. So as we move closer today, we will see how the UCP guideline continue to evolve to meet the need of changing global economy. Now let's see some key provision in 500 and 600, and then after we will see UCP 600. So some key provision which were made in UCP 500, like a credit is deemed irrevocable if it is not stated otherwise. But it means by default a letter of credit is irrevocable, it cannot be revoked. Banks are required to advise a credit even if it can't be authenticated. The reasonable time has been set to 7 banking days to determine compliance. Non-documentary condition to be disregarded, and clarify who can sign transport document and redefine this transshipment. These were the changes which were brought in UCP 500 and UCP 600, and the latest version was UCP 600, which was introduced in 2007, 1st July 2007. It added new articles on the definition and interpretation. It removed references to revocable credit. It includes a new sub-article, and it has set the maximum examination period of 5 banking day. Earlier it was 7 banking day, but it has changed the examination period to 5 banking days. Okay, and documents should fulfill their function even if the credit is silent on data content. And it also provided option for handling discrepant document. That is about UCP 600. Now let's see some definition and key parties in the letter of credit. So first of all, let's see some key concept in international credit. The letter of credit, often refers to as LC. If you have ever wondered how buyer and seller across the globe ensure safe and secure payment, letter of credit is the answer. Let's break down what an LC is and who the key players are and the different types of LC. First thing first, what exactly is letter of credit? So in simple words, letter of credit or LC is a financial document issued by a bank. So it is a financial document which is issued by a bank. It acts like a promise to pay the seller. When I say seller, I mean exporter also, right? So bank promise to pay to the seller or exporter on the behalf of buyer. So on the behalf of whom? On the behalf of buyer, bank promise, right? Or buyer or importer, you can say, once certain conditions are met. These conditions usually involve the seller providing a specific shipment document proving that the goods have been shipped as agreed, right? So guaranteeing the payment to the seller upon presentation of the specified shipment document. That's the key point. Think of LC as a security blanket for both parties in a trade transaction. So you can think of LC like a security blanket, okay, for both the party in a trade transaction. The buyer bank guarantee that the seller will get paid as long as the seller meet all the conditions laid down in LC. Try to understand what I'm saying. The buyer bank, one side there is a buyer bank and one side there is a seller bank. So this buyer bank guarantees that the seller will get paid as long as the seller meet all the conditions laid out in the LC. This reduces the risk for the seller. Obviously, when the buyer bank take guarantee, the risk for seller reduces, knowing that the payment is guaranteed by a bank rather than relying solely on the buyer, because buyer bank is giving the guarantee, right? Okay, so that is the point. That is called irrevocable undertaking by the bank on the behalf of the buyer to pay the seller once all the LD terms are met and the required documents are presented. So now let's talk about the key parties involved in LC. First we have the buyer or the importer, which is also called applicant. This is the person or the company who requests the letter of credit to be opened by the bank. So this buyer or this importer go to their bank and request the bank for the LC to be opened. Then next is seller or exporter, which is refers to as beneficiary. So this is the person or the company that will receive the payment under the letter of credit. So they will receive the payment because they have sent the good, right? Then we have the opening bank or the issuing bank. So this which is also called the buyer bank. You can also call it the buyer's bank. Opening bank or issuing banks or buyer bank. This bank issues the LC. As the name suggests, they issue the LC and guarantee payment to the seller. So this opening bank or the issuing bank, as the name suggests, they issue the LC and guarantee payment to the seller. They issue the LC on the behalf of the buyer and guarantee payment to the seller. And there is also called advising bank. There is also something called advising bank, which is typically located in the seller's country. It is located in the seller's country. This bank authenticates the letter of credit, ensuring it is legitimate, and advises the seller. Two things it does: it authenticates the LC and it advises the LC, right? Advises the seller. Lastly, we might have a confirming bank. This bank usually in the seller country. So you can see advising bank is located in the seller country. Confirming bank is also located in the seller country, right? It adds its own guarantee of payment on the top of the issuing bank guarantee, providing even more security for the seller. So one thing is issuing bank is guaranteeing and confirming bank is also guaranteeing. So two layer security is there, right? So now that we have understood what a letter of credit is and who the key players are, and there is something called reimbursing bank also. Besides this, I think I have not written here: buyer, importer, seller, exporter, opening bank, advising bank, right? Confirming bank, reimbursing bank. This thing also there. Now that we have understood what a letter of credit is and who are the key players, let's look at some different types of letter of credit that you might come across. One of the major type of letter of credit is called revocable letter of credit, right? And the first type is called revocable LC, right? So as the name suggests, this type of LC can be amended or cancelled by the issuing bank at any time without the beneficiary consent. Now as the name suggests, it is called revocable. So beneficiary consent is not required. And this type of LC can be amended or cancelled by the issuing bank without the beneficiary consent, as long it has been used yet. However, these are rarely used today because of their limited value, right? So this type of LC can be amended or cancelled by the issuing bank at any time without the beneficiary consent, as long it has been used it. However, these are rarely used because of their limited value. If the seller present the document before the cancellation notice, the issuing bank still has to pay, right? So this is about the revocable. As the name suggests, it can be revoked back, but in which case the issuing bank cannot revoke if the seller present the document before the cancellation notice, right? Then it cannot be revoked. Okay, so much more common is the irrevocable letter of credit. So in the next slide you will see, first of all we have seen revocable, it can be amended and cancelled, and the second type is called irrevocable letter of credit. So this type of LC cannot be changed or cancelled without the agreement of all the parties involved. That means without the consent of all the parties. Who are the parties? So this type of LC cannot be changed or cancelled without the agreement of all the parties involved. The parties are issuer, that is the LC issuing bank, beneficiary, confirming bank. Okay, so for any type of amendment, for any type of cancellation, consent of all these parties are required. That is what is about irrevocable LC. So it represents a solid unconditional commitment by the issuing bank to pay the seller, provided that all the terms and conditions of LC are met. The condition is compliant document. Documents should be compliant. It's not like that the document are not compliant and issuing bank is bound to pay. No, not like that. If the documents are compliant, if the documents are complete in nature, then only issuing bank will pay, and it is a solid unconditional commitment. This make it a much safer and more reliable option for both buyer and seller, because it cannot be cancelled, right? It cannot be cancelled without taking the consent of all the parties involved, right? So by default, all the LC under UCP 600 are irrevocable unless explicitly stated revocable. So if it is revocable, it will be explicitly stated, and if it is not, if nothing is written, you treat it like a irrevocable LC only. Is it clear now? Now the rule that govern these LC, known as UCP or Uniform Custom and Practice for Documentary Credit, were created by the ICC, right? I think we have covered this irrevocable confirmed LC. Okay, so we will cover this also, right? So the rules, the rule that govern the LC, known as UCP or Uniform Custom and Practice for Documentary Credit, that is called UCPDC. So this was created by whom? This was created by ICC. Who is ICC? International Chamber of Commerce, and the latest version is called UCP 600, and it has been in effect since 1st July 2007, and these rules ensure that the LC transactions are handled consistently and fairly around the world, right? Okay, now let's talk about additional types of letter of credit. So Now we have covered the basics of LC. Let's dive into the additional type of letter of credit that's play a crucial role in the international trade. What are the name? That is called irrevocable confirmed LC, and the other is called transferable LC. So first of all, these type of LC offer extra layer of security and flexibility, making them essential tool for the business around the world. Let's talk about first irrevocable confirmed LC. This type of LC goes a step further than the standard irrevocable LC by involving earlier what we have covered. Earlier we have covered irrevocable LC. We have covered this irrevocable LC, right? And it goes a step beyond this irrevocable LC by involving an additional bank which is called confirming bank. Earlier there were no confirming bank, but now in this type of irrevocable confirmed LC, the confirming bank comes into picture. And usually this confirming bank is located in which country? Can you tell me whether it is importer country or exporter country? It is located in the exporter country, right? So it adds its own guarantee to the payment promise made by the issuing bank. It adds its own guarantee to the payment promise made by the, so earlier issuing bank made the payment promise, and this confirming bank also made the payment process. This means that even if the issuing bank faces difficulty, the confirming bank will step in and ensure that the seller gets paid, provided all the LC conditions are met and compliant documents are presented. So suppose the issuing bank is facing difficulty in making the payment, so in that case confirming bank will step in, okay, and that particular bank will pay, right? This extra layer of security is particularly useful in cases where seller may have concern about the reliability of the buyer's bank, because this issuer bank is none but the buyer's bank. But it is important to note that confirming bank does not just add its confirmation without due diligence. This is very important. The confirming bank, if it just adding confirmation, it must take proper due diligence, right? It carefully assess the risk involved before agreeing to take on this additional responsibility. That's what it is written. It assesses the risk before agreeing to add it confirmation. So if the risks are deemed too high, the confirming bank has a right to decline the confirmation, and it must notify the issuing bank of this decision. So if it thinks that the risk is too high, then it will not take the risk, right? And it will clarify, it will notify the issuing bank of this decision. So in the summary, the irrevocable confirmed LC offer enhanced security for the seller by having not one but two banks backing the payment. This reduces the risk of non-payment and provide more confidence in international trade transaction. Now next comes a transferable letter of credit. So in this transferable letter of credit, it provides flexibility, especially in transaction where intermediaries are involved. Friends, if you are looking for such type of English version lecture for all the subjects of CIB, especially BFM, which we are covering right now, you can WhatsApp me on the number shown on this on the screen. I will provide you such type of explanation for each and every lecture, which is the lucid explanation, making your concept crystal clear, so that whenever you face any question related to this topic, you will feel confident to answer them. So now let's talk about the transferable LC. It allows the original beneficiary, often a middleman or trading company, to transfer part or all of the credit to one or more secondary beneficiary. Let me give you an example to make it more clear. For example, suppose a trading company is there. It might use a transferable LC to ensure payment to its supplier, right? So it allows the original beneficiary. So one is the first party is called original beneficiary, okay, and it allows the original beneficiary, who is often called middleman or trading company, to transfer part or all of the credit to one or more secondary beneficiary. Who is a beneficiary? Seller is the beneficiary, right? Exporter is a beneficiary, applicant is the beneficiary. Okay, so this is what happened in the transferable LC. The transfer is managed by the advising bank. Here advising bank roles comes into play, but it must be done at the request of the issuing bank, right? So advising bank handle the transfer at the request of the issuing bank. It is important to note that the second beneficiary who received the transferred LC cannot transfer it further to another party, right? So the second beneficiary who received the transfer LC, already two beneficiary have become. The first is the original beneficiary and the second is the secondary beneficiary. Now he cannot transfer it further to another party. This one level transfer limit. So key point is one level only one time it can be transferred. One level transfer limit, this is a key point. This one level transfer limit help maintain control and clarity over the transaction. So that's the point. The second beneficiary cannot further transfer the LC to another party. Okay, and the next point is, one critical thing to remember is that not all LC can be transferred. Right, this thing you must keep in mind. Not all LC can be transferred. For an LC to be transferable, it must explicitly state this feature. If it does not, then the original beneficiary does not have the right to transfer the LC to anyone else. So the LC must explicitly state that it is transferable for this feature to apply. If it does not express it, then the original beneficiary does not have the right to transfer the LC to anyone else. Now, these transferable LC are particularly useful in complex trade transaction involving multiple party. It is help to streamline the payment process and provide security to all the parties involved. Whether it is irrevocable confirmed LC or it is transferable LC, these variations offer tailored solution to meet the specific need of international trader. So thank you for watching. If this video helped you understand the different type of letter of credit, please like, share and subscribe to our channel. Don't forget to hit the notification bell so that you don't miss our upcoming videos whenever we cover even more trade finance topic. And if you want such type of lecture for all the subjects, all the units of BFM, feel free to WhatsApp me on the number shown on the screen. I will provide you detailed concept. So in this lecture, what we have covered, just take a gist. So we have covered the introduction, definition of letter of credit, types of letter of credit. These three topics we have covered, and in the next lecture we will start with the operation of LC. Thank you.